Three plus one reasons why 10-year yields in India have been constantly rising since June this year. Crude, currency, and liquidity. These are the three reasons. What's the plus one? Let's dive in. We first take a look at what drove yields all this while. We start with this chart here that show the movement of India 10-year yields from December 2023. Now, why this date? Because this is just months after JP Morgan announced India's inclusion into its emerging market bond indices. 2024 started with yet another bond inclusion news, Bloomberg bond inclusion. We saw aggressive fiscal consolidation from the central government at the start of 2024, even lower fiscal deficit projections, RBI's bumper dividend, S&P's positive rating outlook, and more importantly, all the way till September 2024, US yields fell by nearly 100 basis points and crude prices dropped by more than 20%. Now remember, lower crude prices and US yields greatly help lower India 10-year yields. We then start 2025 yet again with contained fiscal consolidation, front-loaded RBI rate cuts, risk weight drops, excess liquidity, and some more crude price drops. And by May-June 2025, this year, it looked like India 10-year yields had not much lower to go. 10-year yields started moving higher in June this year on the back of crude prices. Remember, crude prices and 10-year yields share a very close relationship. In July, while crude prices eased, rupee saw weakness, and that took the 10-year yield much higher, like you can see in this chart. What happened in August? Excess domestic liquidity contracted a bit and appeared to influence 10-year yields like in this chart. The markets were also a bit concerned about the GST reform and the fear that it would lead to fiscal slippage. Now, we spoke of three variables. What about that plus one? We wrote in detail about this in a monthly EMI for August here. This plus one is about tracking yield movement and the repo rate across rate cycles. What do we see? A very interesting pattern. Whenever the RBI delivers its last rate cut, around this time, 10-year yields start to bottom out, meaning start rising. And the inverse happens. Yields start peaking, meaning start falling, just around the time the RBI's last rate hike. Now, this is mainly because bond markets are always forward-looking and tend to preempt the next rate cycle nearly a year in advance. So what we are trying to say is that this stubborn rise in 10-year yields, apart from the demand-supply angle, over the last 3 months must also be looked at from this angle. Yields could actually be telling us that they are in the process of bottoming. In short, a phase of yield rise ahead, and that is some food for thought.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.